Good afternoon, class. Today we're going to discuss Chapter 4, Additional Income and the Qualified Business Income Deduction. So the learning objectives are to define the term capital asset, apply the holding period for long-term and short-term capital gains and losses, to calculate the gain or losses on the disposition of an asset, to compute the tax on capital gains, describe the treatment of capital losses, apply the exclusion from personal residence sales, apply the tax rules for rental property and vacation homes, explain the treatment of passive income and losses, describe the basic treatment of deductions for net operating losses, and compute the qualified business income deduction, QBI. So what is an asset? What is a capital asset? So when taxpayers dispose of property, they must calculate any gain or loss on the transaction and report the gain or loss on their tax return. The gain or loss realized is equal to the difference between the amount realized on the sale or exchange of the property and the taxpayer's adjusted basis of the property. How gains and losses are reported depends on the nature of the property and the length of time the property has been owned. And so the tax law defines capital assets as any property, whether used in a trade or business or not, other than stock in trade, inventory, or property held primarily for sale to customers in the ordinary course of trade or business, depreciation property or real property used in a trade or business, a patent, invention, model, or design, a secret formula or process, a copyright, a literary, musical, or artistic composition, a letter of memorandum or similar property if the property is created by the taxpayer, accounts or notes receivable, or certain U.S. government publications. Determining the holding period is the first step in determining tax treatment for an asset. The holding period for capital assets is how long the taxpayer owned the asset. So long-term assets are held for more than 1 year. Short-term assets are held for 1 year or less. And so capital gains and losses receive special tax treatment. Tax treatment is based on the length of time property has been owned. A net short-term capital gain is treated as ordinary income. And so a taxpayer's gain or loss is calculated using the following formula. The amount realized less adjusted basis gives you your gain or loss realized. Sale or exchange. The sale or exchange of an asset results in a capital gain or loss. Although not defined in the tax law, a sale generally requires the receipt of money or the relief from the debt in exchange for property, and an exchange is a transfer of ownership from one property for another property. So the amount realized from a sale or the disposition of property is equal to the sum of the money received plus the fair market value of the property received, less the cost paid to transfer the property. If the taxpayer is relieved of a liability, the amount of the liability is added to the amount realized. The adjusted basis of property is computed using the following formula. The adjusted basis equals the original basis plus any capital improvements less accumulated depreciation. The original basis of property is usually its cost, plus any costs incidental to the purchase, including settlement fees and closing costs. Capital improvements are expenditures that significantly result in an increase to the property's value or lengthen its useful life. So calculations of gains or losses. Settlement fees or closing costs included in the basis of real property. So charges for installing utility services, legal fees, recording fees, survey fees, transfer taxes, ownership title insurance, any amount the seller owes the purchaser agrees to pay. So settlement fees or closing fees not included in the basis of a property are amounts placed in escrow for future payments of items like taxes and insurance, casualty insurance premiums, rent or occupancy of the property before closing, charges for utilities or other services related to occupancy or of the property before closing, charges connected with getting a loan. And so basis depends on how property is acquired. If received as an inheritance, original basis is generally equal to the fair value at the time of the descendant's death. If acquired as a gift, amount of basis depends on whether property is sold or gained or a loss by the donee. So now an example. Calculating gain or loss example. August 4th, 2019, Julian sold 326 shares of stock in Nanoplasma LLC that she purchased on June 18, 2003. Her cost basis is $10,000. She sold the shares for $19,000 and paid a commission of $1,300. Calculate Julian's amount realized and realized gain. So here the amount realized is $19,000. What she sold the shares for, less $1,300 is the amount paid in commission, and so it equals to $17,700. Then her realized gain is the realized amount, the $17,700, less her basis of $10,000, her original cost basis, which gives you $7,700. So net capital gains. The tax rate on short-term and long-term capital gains are complex. The 2019 capital gain tax rates are as follows. So here you have the types of gains and your tax rate. Short-term capital gains are taxed at ordinary income rates consistent with filing status. Typical long-term capital gains are taxed at 0, 15, or 20% depending on the level of other taxable income. Long-term unrecaptured Section 1250 gain is capped at 25%, and long-term collectible gains are capped at 28%. The 3.8% Medicare tax on net investment income, including qualifying dividends, applies to high-income taxpayers with income over certain thresholds. So refer to table on pages 48 and 49 for 2019 rates for typical long-term capital gains. Ordering rules for capital gains. Since there are multiple kinds of capital gains on which to calculate tax, it is necessary to order capital gains included in taxable income. And so capital gains are ordered as follows. You have short-term capital gains, unrecaptured Section 1250 gains on real estate, gains on collectibles, and long-term capital gains. The calculation of a net capital position. So step 1, classify the capital gains and losses as long-term or short-term and net by groups. Step 2, determine the net capital gain or loss. And here's the illustration. Net long-term gain, capital gain offset by net short-term capital loss, and net long-term capital loss offset by net short-term capital gain. This is going to make sense when we walk through an example. And so net capital position, Chavro has the following capital gains and losses in the current year. And so he has a short-term capital loss of $2,000, a long-term capital gain of $12,000, and a long-term capital loss carryover of $7,000. It was carried forward from a prior year. What is Chavro's net capital position in 2019? What are the tax implications for Chavro's capital activities if he has adjusted gross income of $42,445 and his filing status as head of household? And so step 1, the net short-term capital gain or loss was $2,000. The net long-term capital gain or loss is $12,000 plus the $7,000 loss, which is going to give you $5,000. And so his net capital position is a short-term capital gain of $2,000 plus the net short-term capital loss of $2,000 plus a net long-term capital gain of $5,000, which gives you $3,000, and it's a long-term capital gain. So Shavel's $3,000 long-term capital gain will be taxed at 0% because he has AGI of $42,445 and his filing status is head of household. See capital gains tax table at the top of page 49. Shavel's taxable income is 0 to $52,750. Treatment of net capital losses. So net capital losses may be deducted against ordinary income in amounts up to $3,000 per year with an indefinite carry forward. The nature of the capital loss must be maintained when carrying it forward. If a taxpayer has both net long-term losses and net short-term losses in the same year, the net short-term losses must be deducted first. Personal capital losses or losses from the sale of personal capital are not allowed for tax purposes. Ordering rules for capital losses. When a taxpayer ends up with the net capital loss, the losses offset capital gains using the following ordering rules. Net short-term capital losses first reduce 28% of gains, then 25% of gains, then regular long-term capital gains. Net long-term capital losses first reduce 28% gains, then 25% gains, then any short-term capital gains. So sale of a personal residence. So sales after May 6, 1997, an exclusion against income for gains on the sale of personal residence after May 6 of 1997 is allowed if the seller has owned and used a home as a primary residence for 2 of the last 5 years before the sale. The gain exclusion is up to $250,000 and $500,000 for joint return filers. This is very important. This means that they can sell the home and not have to worry about calculating any type of gain. Beginning in 2009, Congress closed a loophole in the residence gain exclusion laws. Prior to 2009, taxpayers with multiple rental properties could move into a previously rented property every 2 years, reside in the property for the required 2-year period, and then sell the property using the $250,000 or the $500,000 gain exclusion. Beginning in 2009, taxpayers who rent the residence prior to their 2 years of personal use are generally limited to an exclusion smaller than the full $250,000 or $500,000. And so here, they were taking property that they were using to make income. They were moving into it and living there for 2 years, so they can use it as a personal residence, so they can get an exclusion when they sell it. But they've gone in and adjusted the tax code to where they still would get an exclusion, but it wouldn't be as much. So sales before May 7, 1997. Note the law described below no longer applies to sales of principal residence. So for sales of personal residence before May 7, 1997, taxpayers did not have to recognize a gain on the sale if they rolled the gain into a new house with a cost as high as the adjusted sale price of the old residence. Therefore, many taxpayers who sold one or more principal residence over a period of years under the old law have a principal residence basis that is far lower than the cost of that residence. So because the current law does not require rollover treatment, these taxpayers get a fresh basis equal to the purchase price of the newly purchased residence. Rental income and expenses. Net rental income or loss is part of the taxpayer's taxable income. In most cases, rental income is reported on Schedule E. So vacation homes, the deduction of expenses associated with a vacation home are limited to the income generated from the rental of the property. There are 3 categories of vacation homes in which tax treatment differs for each category. Primarily personal use, primary rental use, and rental personal use. And so under primarily personal use, it's treated as a personal residence if rented for fewer than 15 days during the year. Rental period is disregarded. The rental income is not taxable. Mortgage interest and real estate taxes are reported as itemized deductions on Schedule A, and other expenses such as utilities and maintenance are non-deductible personal expenses. Primary rental use. Treated as a rental property if rented for 15 days or more and used for personal purposes for not more than 14 days or 10% of the days rented, whichever is greater. And so they must calculate expenses between personal and rental use. And so personal use percentage is the personal days divided by the total days used. rental percentage, rental days divided by the total days used, and rental deductions, expenses times rental percentage. If your rental deductions exceed rental income, taxpayers can deduct loss against other income subject to passive loss rules. Personal percentage of mortgage interest and real estate taxes are reported as itemized deductions on Schedule A. And so here is basically telling you you're gonna divide up these expenses, and so some are going to go on Schedule A, some will be on Schedule E. Rental and personal use must allocate expenses between rental and personal use using the formula on the previous slide. If rented for 14 days, 15 days or more, and used for personal purposes for more than 14 days or 10% of the days rented, whichever is greater. And so allocable rental expenses are deducted in the following order: interest and taxes, utilities and maintenance, and depreciation. For utilities and maintenance and depreciation must be positive income following the deduction of the items of the preceding steps. Personal percentage of mortgage interest and real estate taxes are reported as itemized deductions on Schedule A. So now we have an example. Rental income and expenses. So the Mbell family owns a ski condo in Alta, Utah. In the current year, personal use is 25 days and rental use is 50 days. Data pertaining to the rental are as follows. So they have rental income of $10,000, interest of $3,000, taxes $1,500, utilities $2,000, insurance $1,500, snow removal $2,500, and depreciation $12,000. The amounts were reported on Schedule A and E for the current year. What amounts will be reported on Schedule A or E for the current year? Hint: first determine what category the condo is in and then allocate the expenses. And so since the condo is rented for 15 days or more, the Mbell family uses it for personal purposes for more than 14 days or 10% of the days rented if greater. The property is subject to the vacation home limitations. And so gross rental income is $10,000 less the interest and tax, gives you a $7,000 balance, less other expenditures of $4,000, less depreciation of $3,000. And so the net income is zero. And here they have the days, the percentage with the 50 days divided by the 75 days in total for each of the expenditures to give you the difference on what you should be claiming on Schedule E. So the interest and taxes allocable to the Mbell family personal use of the condo may be deductible as itemized deductions on Schedule A. The rental portion of interest, taxes, and other expenses reported on Schedule E. And the $5,000 non-deductible portion of depreciation can be carried forward to the next tax year. And so here for the personal use, you're going to divide up to 25 days by 75 days to get your percentage. And for the rental, remember it was 50 days, and 50 days divided by the 75 days for your percentage. And you apply it against each of the categories of expenditures, the 4,500 and the 6,000. So 3 classification of individual income: active income, portfolio income, and passive income. Active income includes wages, self-employment income, and salaries. Portfolio income includes dividends and interest. And passive income and losses are rental, real estate income and losses, loss passed through from limited partnership or other ventures in which taxpayer has minimal or no involvement. When a taxpayer has minimal or no involvement in activity, generated loss are passive and may not be deducted in excess of passive income. Passive losses generally cannot be used to offset active or portfolio income. Any unused passive losses can be carried forward and deducted in future years against passive income. Losses remaining when the taxpayer disposes of his or her entire interest in the passive activity may be used in full. And so this is just defining that past income in category 3 cannot go against income in category 1 and 2, the losses. Rental property is specifically designated as passive even if taxpayer actively manages the property. However, individual taxpayers may deduct up to $25,000 of rental loss against other income if they are actively involved in the management of property. The $25,000 loss deduction is reduced by 50 cents for each dollar the taxpayer's modified AGI exceeds that amount. Therefore, no deduction is allowed when the taxpayer's modified AGI reaches $150,000. Different rules apply if taxpayer is married filing separately. And so real estate and rental as a trade or business, taxpayers heavily involved in real estate rental activities may qualify as having an active business. For a real estate rental to be considered active, both of the following must be met. More than 50% of the individual's personal service during tax year is performed in rental property trade or business. More than 750 hours of service is performed by the individual during the tax year in rental property trade or business. If both conditions are met, taxpayers may then deduct the entire loss on his or her tax return as an active business, not a passive loss. So in this case, if you're engaged fully, 50% more than time engaged in rental property activity, then it could be active trade or business instead of a passive loss. And this is important because you can take it against your active income if you have another job or any other sources of revenue. So, an example, Bobby Joe is single and owns a rental duplex that shows a loss of $20,000. Her modified AGI before the loss is $118,000. What about a rental loss can be claimed? How much could be claimed if her loss is $2,800? And so the solution is step 1: a modified AGI exceeds $100,000. So $25,000 total loss capability must be reduced. And so here you have $118,000 less $100,000, so it's $18,000 in excess. And so $18,000 times 50% less the $25,000 gives you $16,000. So only $16,000 of the rental loss can be deducted, which is 50% of the AGI in excess of $100,000, less than $25,000. If Bobby Joe's loss was $2,800, the full $2,800 can be deducted. The net operating loss provisions is primarily designed to provide relief or loss from trade or business and casualty or theft. Therefore, all items of income deduction gains and losses must be categorized as either business or non-business related. So a net operating loss 80% limitation. So net operating loss generated after December 31st, 2017 are limited to 80% of the current year's taxable income. Net loss generated prior to 2018, January 1st, 2018, continue to be used 100%, necessitating tracking of different NOL periods. So the carryback provisions are repealed and NOLs may only be carried forward. So overall business loss limitation, the tax law places a $510,000 for married filing joint taxpayers and $255,000 for all other taxpayers. Annual limitations on non-corporate business losses. Any excess of business loss limited under these rules becomes part of the NOL for future years. And so here they're basically describing if you have a net operating loss, the tax treatment, and how it can offset your income. Definition of qualified business income. So qualified business income for the tax year is the net amount of qualified items of income, gain, or deduction loss relating to any qualified trade or business. The QBI deduction is also called a Section 199A or pass-through deduction. The QBI excludes the following: short-term capital gain, short-term losses, long-term capital gain, and long-term capital losses, dividend income, interest income other than interest income property applicable to a trade or business, commodity transaction income or foreign currency gain or loss, any item of income gain, deduction or loss related to certain notable principal contracts, and amounts received from an annuity not related to the trade or business. So the tax law provides a safe harbor under which income from rental real estate, even if treated as passive, can qualify as a QBI. The requirements are 250 hours or more are spent by the taxpayer with respect to the rental activity. Contemporaneous records of the time are maintained, and separate books and records for the rental activity are maintained. The QBI deduction taxable income limitations. The QBI deduction cannot exceed 20% of the taxpayer's taxable income, excluding net long-term capital gains and qualified dividend income. So this is another way of treating a rental property. So wage limitations for the QBI for taxpayers with taxable income above certain thresholds: $321,000 for married filing joint, and $160,000 for married filing separately, and $160,700 for all other taxpayers. Two additional limitations apply, and a phase out occurs. They are the wage limitations and the specified service business limitations. The wage limitation is the greater of 50% of the allocable share of W-2 wages with respect to the business, 25% of the allocable share of W-2 wages with respect to the business, plus 2.5% of the unadjusted basis for all qualified business property. To calculate the phase out, taxpayers must determine the QBI deduction with and without the wage limitation. The excess of the QBI deduction with no limitation for the QBI deduction with limitation is known as the excess amount. The excess amount is subject to the pro rata phased out based on the taxpayer's income over the threshold amount. So specified service business limitation. And so a QBI from a tax-related trade or business may also be subject to limitation if the income is in excess of the threshold. These include taxpayers whose business is being an employee, specified service business such as law, accounting, financial services, performing arts, and the like. Reporting the QBI deduction. In 2019, the IRS introduced Forms 8995 and 8995A for reporting the QBI deduction. Form 8995 is for taxpayers whose taxable income before the QBI deduction does not exceed the phase-out thresholds. Otherwise, taxpayers must use Form 8995A. That brings us to the end of the lecture. I know some of these concepts are very detailed. There are examples and practice questions in the Moodle that you will perform, and you'll be able to understand these concepts in more depth. Please reread the chapter, attempt to practice questions. Have a good day.